and welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. Stewart, how are you today?
Oh, I'm doing awesome. How are you doing?
I am fantastic. I'm so excited about today's show. We're going to be talking about current market conditions. That's a big one. How to take advantage of this down market with a plan, and also important steps to take before the end of the year. So, Stewart, I'm going to have to ask you right out of the gate. The market seems to be all over the place right now. What do you see happening?
Well, right now, obviously, we're seeing this just crazy, incredible volatility that's going on. The market is clearly down from its highs at the end of last year here, at the end of in November and December of 2021. The markets were at a peak. They've been just spiraling downhill all year. We've seen some bounce back here and there. There have been some false signals back and forth, but it's definitely been a fun ride here. I think people have just been used to this market that's gone on a nice run for a long period of time, and I think those days of smooth markets are over here for a while.
Well, I have to ask you, Stewart, what causes all of this volatility?
Well, I think right now what we're seeing is, the one word on everybody's mind is inflation. And, apparently I know there's a news host out there or a commentary host out there that says inflation is just an invented word by one political party. And when you go to the gas station, you pay more for gas, you're paying more for, food. I don't think it's an imaginary thing, right? I mean, it's really costing more to buy stuff.
Absolutely.
And so just remember that our Federal Reserve Chairman, Jerome Powell, has been very clear about his direction that he's looking to take. And I think what people have to realize is that the volatility that's being created is because of these increasing interest rates that we're seeing. And Jerome Powell has said very clearly that the two main mandates of the Federal Reserve is number one, full employment. Number two, keeping inflation under control. And typically they've talked about 2 to 3% inflation. And people are really excited about last year's inflation because of the CPI numbers. We saw a 5.9% increase in Social Security, but of course, that was accompanied by an even higher increase in Medicare costs. So that was offsetting, right?
Absolutely.
We recently got the numbers for next year's Social Security, which will be 8.9%. So, we're seeing these really high inflation numbers, and that just means stuff is costing more. And what you have to understand is that it's not just this fictional number on a screen. It's really, really important. And so, the Federal Reserve Chairman, who has really kind of mimicked or mocked Paul Volcker, who was a previous chairman of the Federal Reserve, who is known for having those super high inflation rates in the late 70s, early 80s, he's basically said, look, I'm comfortable with what he did. It was a hero of his. So he has been very clear to say that, we're willing to sustain a certain amount of pain to get through this inflation. But I think, Cynthia, what you really have to understand is what that pain means, right? Yeah. By raising interest rates, they're making stuff more expensive. For example, I recently bought a car, wasn't paying too much attention to the interest rates, but we're now seeing car interest rates at 7.9%.
That's true.
We're seeing mortgage rates. You're an expert in the real estate world and out in Charlotte, and I mean, you've seen what's happened to mortgage prices. Where
absolutely, yes.
A year and a half ago or so, we're seeing 2.8% on the 30-year. Today, we're seeing in the 7% range. So now, obviously, mortgage people have to be more creative to sell the houses and to make that, still feasible, right?
Very true, Stuart. I have to ask you, obviously, if raising the interest rates, if that's bad for the markets, why do they keep doing it, in your opinion?
Well, I mean, that's the big question, right? I think the position of Federal Reserve Chairman isn't supposed to be a political one at all. But sometimes you just feel that they get pressured by the administrations to move in a direction. This administration isn't the only one to really kind of add pressure, so to speak, to the Federal Reserve. Donald Trump was, he's the guy that would tweet, if somebody did something he didn't like, he would tweet about it and people would move. I think people were scared.
Yeah.
And I think that, these people are human beings and they're, susceptible to this kind of, crazy pressure. But I think, the reason they keep doing it is they're just trying to get that inflation number down, despite the pain that it's going to cause. And we know it's going to cause pain. Look, it's really tough to hire people nowadays, right? We've, I think, a combination of COVID and, this great economy has really changed the way people look at work. I mean, we were trying to hire CPAs for 2 years, and literally all of them want to work remotely, and they try to convince us that, hey, it's okay. Everyone's used to Zoom now. And well,
True.
no, like, at our company here in Phoenix, we're very focused on that kind of in-person relationship.
Yes.
And other firms have had more success at doing Zoom calls. I prefer not to do them. Maybe I'm just not very good at them. I don't know.
Well, I'm with you. I never know where to look. I'm always like looking all over the place. So I have a question for you, Stewart. Obviously, with things that are changing right now in the economy, people that are in the viewing audience today, what can they do with their own financial situation to adapt to this new environment that we have economically?
Well, number one, I think, I always use this boxing analogy where, if you realize we're in crazy times. We're in a fight here. We're in the middle of this big fight. And if a boxer just closes his eyes and, just starts doing the windmill thing and starts swinging and isn't looking at his opponent, he's going to get knocked out.
True.
That's the same thing we're seeing from clients. Right now, we're seeing, people that are coming in, they're calling in from our TV shows looking for help. And they're saying, hey, you know what? I just don't even want to look at my statements. I have not looked at them in months because I know they're going to look bad. Mm-hmm. Well, guess what? It's like the ostrich that buries his head in the ground so he doesn't have to see that charging bull running at him. He's going to get knocked over and destroyed. And I think the first thing you need to do is have a plan. And a plan is a super important thing that most people don't have. They've been used to this 12-year bull market, and they're thinking that, hey, things are just going to continue.
Well, Stuart, I have to ask you, when you and your advisors are meeting with clients for the very first time, do they have a plan in place?
Well, typically, like I said, most clients don't have any sort of plan at all. And I think, number one, it's really important to find out, hey, do you have a plan in place, and what should that plan look like? And most people don't realize the kind of risk that they're currently taking in their portfolios. They don't have any sort of real tax plan. They don't have any sort of real, understanding of what it's going to take to retire and actually stay retired.
Well, Stuart, we're going to take a very short commercial break. Would that be okay?
I look forward to it.
All right. To our viewers at home, we're going to take a very short commercial break. We want you to know when we come back from that commercial break, we're going to be addressing two very important topics. Number one, is your financial plan up to par? And if not, what can you do to tweak it? And also, what can you do right now to take advantage of this market downturn? Stay tuned. Don't go anywhere. We'll be right back after this very short commercial break.
People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. When a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. Stewart, a great show we're having today. Such a timely show talking about everything that's going on in the economy and the markets. I have to ask you, if people have been fully reliant on the stock markets and we've seen so much volatility, what advice and guidance do you have for those folks today?
Well, number one, I think you have to put into perspective, where we are today and where we are relatively. And And I said it before the break that people have been relying on this 10 to 20% return in the market. And I think what's important to do is to put into context where we are today. And now I have this slide that'll show the history of the S&P 500. And what this will do is really show you, look, for the last 12 years, we've seen this massive run. And of course, you see the downturn towards the end of that chart, right? That's where we're heading now. But a lot of people have basically gone into retirement thinking, hey, I've got $500,000 saved. I'm going to make 20% a year. That'll provide me $100,000 a year forever. But guess what? That's not going to happen, Cynthia.
Yeah.
We're not going to see consistent returns every year. And one thing I do want to point out eventually is that if you take a look at this chart and you look at, from 2000 to 2012, that S&P 500 made no money at all. Let's pull that chart up one more time. And if you take a look at that, you can see those two humps there on the left of the screen here. The market made nothing essentially for 12 years in the S&P 500. The NASDAQ took 16 years to get back to where it was in 2000.
Wow.
So, Cynthia, I just say this. What if we are now re-entering this lost decade, right? That's that
true.
lost
That's
decade.
true.
So for that 10, 12 years, market made nothing. 16 years, if you're in the tech, sectors, you made nothing.
Yeah.
If you did what the indexes do, and most people don't perform as well as the indexes.
Right.
So I think what's really important when it comes to having a plan is to say, have you ever cash flowed out your retirement? Do you really understand, all of the risks that you're currently taking? Because, Cynthia, everybody is aggressive in a bull market, right? Because when you've been desensitized to these crazy rates of return for a decade, you just feel like, hey, I'm getting rich out here. I'm making 20% a year. It's super safe because everyone's doing it. And then we see years like we've seen today.
Of course.
Right? And even the most conservative people that have decided to take the position of, hey, let's shift over to bonds. Like if you have a 60-40 portfolio where 40% of your portfolio is in bonds or 60% is in bonds, we've seen this crazy bond market as well, right? Where bonds have been safe because for 35 years, interest rates have fallen. And then at the bottom of COVID, we started seeing this massive uptick in rates. And what does that mean? Well, we'll just think about it like this. If you buy a bond and it's paying, currently 2% for the next 10 years, and then next year interest rates are paying 4%, who's going to buy your bond? Right? Well, someone will buy it, but they're not going to give you your $1,000 par value that it cost you.
True.
They may give you $700 or $800, and that's how we start to see these bond crashes.
Yeah.
We use this example. If you look at the 20-year Treasury, there's an ETF, a great ETF that BlackRock has from iShares called TLT. It's the 20-year Treasury. If you look at that long-term Treasury bond, and or that bond fund, and you would have had 40% of your money there, that thing is down 30+%. So even if you were what we call historically conservative, not politically, but from an investment perspective, you're still down 30% even in these bonds.
Wow.
So you're darned if you do, you're darned if you don't.
Yeah.
If you were aggressive, you lost money. If you were conservative, you lost money. There was nowhere really to hide, because what most people have done is they've used these very static models when it comes to investing. So I think it's really important to understand and to reassess what kind of risk you're really comfortable with, because this year has really been an awakening to a lot of people that have historically not been very comfortable with risk, and I think people need to get that assessment.
Absolutely, Stuart. And obviously it sounds so confusing. I'm wondering if the viewing audience is feeling this way at home as well. How do people know what needs to be included in their financial plan if they're wondering that right now?
Yeah, I think first of all, the risk assessment is everything. I think it's really important to say, how much are you comfortable losing? Okay, number one, you got to get the risk assessment. Number two, you need to find out if you're really diversified or not. And, I see clients all the time that are using these historical norms from their these diversified portfolios, but oftentimes, like if you're in these target date funds in your retirement accounts, I mean, it's really crazy because they're relying on historical data where interest rates were falling, right? Have a bunch of international stuff. Well, if you have a substantial amount of international exposure in your portfolio, just remember, Europe's at war for the first time in 70 years. We're in crazy times. So I think, I had a really good friend of mine that was a mentor to me in the financial world when I was getting into the business about 23 years ago. And he said, sometimes you just need to shake your Etch-a-Sketch and start over. Sometimes the old rules don't apply.
Yeah.
Right?
Yeah, that makes sense.
Yeah, so a lot of these kind of classical asset allocation models just don't work. And, I have a slide that I want to show you to kind of show you the difference between a couple different models. This one is, it compares tactical investing to passive investing. And so what this slide will show you is one of our money managers that we use at Asset Preservation Wealth actually has identified 6 distinct stages in the economic cycle. And basically what this slide is showing you is that there are different investments to buy at different stages of the economic cycle. Just use some logic. If we're going into recession or already in recession, well, there's certain things that you need to historically buy.
Sure.
Right?
Sure.
And the opposite is true as well. If we're going into expansion, we're starting to see this amazing market, well, then you can start to be a little bit more aggressive. But what we've seen is a lot of different financial planning organizations, even some of the great ones there, have basically taken the approach that no, we're going to hold to this, 60-40 portfolio regardless of what happens.
Yeah.
Does that make sense?
It does. It does. And obviously, Stuart, we've talked a little bit about this, but obviously bonds had always been such a safe investment choice, but
Right.
totally different perspective right now.
Yeah, it's completely different. And look, I think the interest rates will stabilize eventually once we hit, peak inflation. Clearly, they're not, we're not in a position where interest rates are, going to be stabilized and inflation is still not under control. Until we fix the supply issues, especially on domestic fuel and energy. Look, we're heading into winter now, and the pressure is just going to keep adding and adding and adding. And I heard a statistic the other week that we only have 24 days of diesel fuel in our capacity now. Like that is, I mean, it's a very scary time because what if we run out? Right? We've started releasing all of this fuel from the strategic petroleum reserves. And that is a very scary thing when we start to run low in our strategic reserves, because that stuff isn't meant to lower prices in these very, it's meant to be used in small windows, and it's also meant for wartime. Look, if Europe can go to war, it's very possible we do as well. We may be drawn into some sort of China action, right, with Taiwan. I mean, things are getting a little nutty out there. So I think what's important is that people have a plan. And I think it's important to know what kind of risk you're taking. And honestly, it makes sense for people to, get a second opinion.
Yeah. Well, Stuart, I know people in the viewing audience right now, they're wondering, what can we do? What do we do? How do we help solve this? So you have a very special offer to present. Let's talk about what that is.
Yeah, absolutely. So what we're offering the audience this week here is for the first 10 callers, and we are absolutely swamped. This is end of year tax planning season. But what we're offering to do is a complimentary portfolio review. All you have to do is pick up your phone, call 833-652-7829, or even easier, you see that little QR code in the corner of the screen there? Pick up your phone, click on that QR code. It'll take you to apsitaxes.com. And if you go to that website there, you sign up for a complimentary portfolio review. What we'll do is we'll tell you what kind of risks you're taking, what kind of fees are you paying, do you have too much exposure to long-term bonds or international stocks? We'll let you know, but you have to take action and give us a call. Just give us a call at 833-652-7829 or click on that QR code. We'd be glad to help.
Stuart, thank you so much. To our viewers at home, that number to call is on your screen. That number is 833-652-7829. We're going to take a very short commercial break, but don't go anywhere. When we come back, I'm going to ask Stuart about how do you know if you're diversified enough in your portfolio. Stay tuned for his answer.
Right now, the market is a big mess, and oftentimes people feel lost. So while most people are scared, you need to know that you're going to be okay. I'm sure you have a lot of concerns about whether your portfolio really fits you. And if you need help, all you have to do is give us a call. At Asset Preservation, what we offer is a complimentary portfolio review. We can provide that fresh set of eyes to give you that second opinion. You can't get a second opinion from the guy who gave you the first. You want to make sure you're dealing with a fiduciary. We'll give you that fiduciary perspective. If you have a relationship with a financial advisor that you don't entirely enjoy, I think that's a problem, because these relationships are not meant to be short term. They're meant to last a lifetime. You don't want to deal with people you don't like. If you have concerns about your portfolio, you need to give us a call.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation, Wealth and Tax. Stewart, a great question that I have is, how does someone know that they're diversified enough in their portfolio?
Well, once again, I think a lot of people use the word diversification and they think about the diversification of their investments, meaning do they have, an appropriate amount of stocks and bonds, or the assets not all correlated? Do they do different things? That's really important. And what we often find is that people have a lot lower diversification than what they expected. The next thing we talk about is a diversification of perspectives. So at Asset Preservation, what our company does is we make sure that it's not just one person giving you advice, but it's multiple money managers involved. Think about this. If you're at one of these big box firms and you're sitting across the desk from an advisor that's picking out funds for you, saying, hey, I think you need to be in this growth fund and this international fund and this fund here. My question to you is this: what if they're wrong? Are you comfortable gambling your entire life's work around one person's point of view?
Right.
So what we do is we use multiple points of view. And I think when we use those multiple points of views, for example, we have one of the largest money managers in the world overseeing, one of our groups of portfolios. We have an algorithm money manager that I showed you earlier that identified those 6 distinct stages in the economic cycle. Right? We also have a strategic manager that spent 14 years at one of the great bond houses in California, based in Newport Beach. Phenomenal. But all these guys see things differently, right?
Absolutely.
So we're not putting all our eggs in one basket. And I think it's really important to find out whether or not they're diversified in that way. Does that make sense?
Totally makes sense. Thank you, Stewart.
The other thing is diversification of tax classes. Now, what I mean by that, when I say diversification of tax classes, do you have IRA? Do you have Roth? What kind of tax planning have you done to make sure that going into retirement that you're going to be ready for retirement? Because remember, we are in the most efficient tax window in history right now. I'm going to pull up a slide. It's going to show you some tax bracket comparisons from before the Tax Cut and Jobs Act here. But if you take a look at that, we are in the red right there now. And at the end of 2025, those tax brackets are going to sunset. Most of our clients are between that 22 and 24% bracket. Some are in that 12. But remember, that 22% bracket is going to be 25 to 28%. That 24 is going to be 28 to 33 if Congress doesn't act. And look, don't care if you're a big fan of Trump or you hate Trump, doesn't matter to me. But we saw one of the greatest tax reductions for the middle class in history. And that is all going away if Congress doesn't act. And just remember, that happened during one of the greatest economies the world's ever seen. It's a lot easier to lower taxes when the economy's going well compared to now. Because look, we spent trillions of dollars because of COVID.
Sure.
Right? All of the stimulus dollars, people know that the national debt is going through the roof. Our deficits are through the roof because of that. It's tremendous. And so the likelihood, I believe, of seeing another further tax cut is very unlikely. So just remember, this is super important. We're at the end of the year. There's only 4 years left to really have a plan. One of those things is to determine whether a Roth makes sense for you. And if you say, hey, my income's too high, Cynthia, I don't qualify for a Roth, because a lot of people realize that there's limitations in income that you can make to contribute to a Roth. Well, guess what? There's something called a Roth conversion. And that Roth conversion allows you to pay taxes now. You convert your existing IRAs or thrift savings plans or deferred compensation plans. You roll those to IRAs, then you convert them to a Roth. You pay the taxes now in this lower tax environment, and you may be able to save taxes for the rest of your life, because a lot of people, Cynthia, don't consider taxes when it comes to their plan. And just remember, Social Security was never meant to be taxable. But your IRAs, your 401ks, your pension plans, all those things make Social Security more and more taxable. And most people don't even consider taxes when it comes to a plan.
Well, Stewart, with only a couple minutes left of the show this week, I want to ask you one final question. With taxes being so important, why do other advisors not talk about taxes?
Well, quite honestly, Cynthia, most advisors are prohibited from talking about taxes by their firm. They, if you see on your statements, we are not giving you specific tax advice, etc. But also, you have to think about this. Advisors do the least amount of work necessary to get paid. They've never been required to give tax advice. I have clients all the time that say, hey, I've been watching your show here for the last couple of years, and this is our 89th show that we're recording today. I mean, isn't it crazy how time's flown?
Yes.
But people say, hey, I realize this is good for me. So they go to their advisor. Their advisor said, hey, you know what? Roths are good. Go talk to your tax advisor. Your tax advisor says, all right, yeah, it's a good idea. Talk to your financial guy. And guess what? The right hand never knows what the left hand's doing, and a plan never gets made. But what we're doing is we're challenging the audience today to take action, to find out whether or not a Roth makes sense for you. So what we're going to do is we're going to issue a challenge. This is the Roth Conversion Challenge. You can go to the rothconversionchallenge.com or give us a call at 833-652-7829. Even easier, click on that QR code. What we're going to do is we're going to make an offer to our audience that for the first 10 callers today, or people that click on that QR code and visit the rothconversionchallenge.com, we're going to offer a $50 complimentary gas card just for participating in the Roth Conversion Challenge. All you have to do is bring in your statements. We'll analyze your statements, give you that complimentary portfolio review, and we'll tell you whether or not a Roth makes sense for you. Remember, time is running out. We've only got a few years left to act. You're going to look back at this time and realize, I should have acted. I needed to have a plan, but you need to take action.
Thank you so very much. To our viewers at home, thank you for spending time with us today. That number is 833-652-7829. Be safe, be happy, be blessed. We'll see you back 1 week from today on the Asset Preservation Hour with Stewart Willis.